Hello students, welcome to Dr. B.R. Ambedkar Open University, Hyderabad. Today for MBA Semester 1, Accounting for Management, Block 4, Understanding Financial Statement, Unit 16, Cash Flow Statements. So students, after studying this unit, you should be able to explain the concept of what is meant by cash and what are cash equivalents, appreciate the utility and importance of a cash flow statement, which will be prepared as per Accounting Standard 3 given by Institute for Chartered Accountants of India. And also you should be able to differentiate between direct and indirect methods of preparing the cash flow statements. And also you should be able to highlight the objective and scope of the cash flow statements. So these points will be going to cover in this session. So what is the purpose of preparing a cash flow statement? Why we need to prepare a cash flow statements? So as a part of understanding our financial statements, we need to know about how to prepare a cash flow statement. So the financial statements are prepared on accrual basis of accounting. That means irrespective of whether we are receiving the actual cash or whether we are paying the actual cash, so the financial statements are prepared based upon the accrual principle. That is, as and when a transaction was happened, irrespective of the flow of the cash, it will be recorded in the financial statements. So accordingly, at the end of the year, the financial statements will be prepared. So profit and loss account, a trading account and the balance sheet are prepared, all are prepared on the accrual basis of accounting. As a result of accrual basis of accounting, the cash balance at the end of the year may not be reflecting the true cash that is generated. We should not be able to understand, we are unable to understand how the cash balance is reflecting, how there is a variation from the opening balance and the closing balance. Because the profit and loss account is prepared based upon the accrual basis. Whatever the profit that is generated also will show you an profit that is generated on the accrual basis. That is not the true profit in the form of cash. So it is essential to know that what is the actual cash that we received. To understand that, to understand the actual cash flows, we need to prepare a statement called as cash flow statements. So let us try to understand how it is going to be useful, what are its objectives and what are the scope of the cash flow statements. So users of the financial statements of a business enterprise may be interested in the enterprise way of generating and using the cash and cash equivalents. So it is one of the important objective for any person dealing with the business organization. They should know about what is meant by the cash, from what sources the cash is generating, and cash equivalents. What is meant by cash equivalents? So we'll be discussing in the coming session what is meant by the cash equivalent. So the overall objective of the users of the financial statement should be, one of the objectives should be to understand the flow of cash and the cash equivalent. And to put it in a very simple way, we all know that without cash nothing can be happened in the business organization. The physical cash, the actual cash. So what is the actual cash in hand? What is the actual cash in the form of its equivalent? Which components we can be considered as equivalent? So that is essential to understand what are those components. So it will help you to play your observations, and also it will help you to. So cash flow information is useful in assessing the ability of the enterprise to generate the cash and cash equivalents, and enables the users to develop models to assess and compare the present value of future cash flows of different enterprises. So it will help you to understand from what are the various sources that cash is generating, how we are using the cash, and what is the opportunity of generating the future cash flows. So these cash flow statements will help you to generate such a perspective from the organization point of view. So with that, you can also able to assess the present value of the future cash flows. What is meant by future cash flows? Future cash flows are nothing but what we are going to derive in the future. Present value of the future cash flows, we can discount the cash flows that we are going to get in the future, and then we can understand what is the present value of your cash flows. Information about the cash flows of an enterprise is useful in providing users of the financial statement with a basis to assess the ability of the enterprise to generate that cash and cash equivalents and the needs of the enterprise to utilize those cash and cash flows. So we will be able to understand what are various sources from which the cash is received, whether it is a physical or actual cash, or it may be in some other form which will be in nearest way to convert into the cash. So it is always essential, the liquidity of the business organization will be ensured with respect to the flow of cash inflows and outflows. So that will be helpful to understand what will be your major sources of revenues and what will be your major expense applications of, what will be your major application of money, so that we can able to forecast about our future requirements. Whether we can do it orally as you like, no, it cannot be. So It is one of the important component for any business organization. So that is why the accounting standards has been specified for the purpose of preparing a cash flow statement. For the specific purpose, there is an accounting standard called as Accounting Standard 3, which was revised by the Institute for Chartered Accountants of India, which deals with the provision of information about the historical changes in the cash and cash equivalent. So this will provide you the guidelines how to consider the cash and cash equivalents, how to present them in the form of a statement, how to categorize those cash flows. So as per the guidelines given by the Indian Accounting Standard 3, so normally the cash flows, whether it is inflows or outflows, are broadly classified into three categories. One, operating cash flows, and investing and financing activities. So the cash flows that are generating by the company may be of three types more, as defined in the Accounting Standard 3, that is operating, investing and financing. So based upon that, any person preparing the cash flow statement should follow the guidelines given in the accounting standards, and we will be understanding what are the specific guidelines given in these standards, and accordingly we will be preparing a cash flow statement. This standard is not mandatory for small and medium sized enterprises. See, application of accounting standard is mandatory for the company form of organizations. Other entities, as per the requirements, to fulfill more regulatory requirements, they can follow voluntarily. It may not be necessary, but following of the accounting standards will provide better scope for the business organization to understand its performance and also to understand its scope in the future. So normally, though it is not applicable for the small and medium scale enterprises, if they are desired of using the standard, they can use it. But for the company form of organizations which register under the Companies Act of 2013 or any other acts, they can mandatorily follow the Accounting Standard 3 for the presentation of cash flow statements in their financial statements. The cash flow statement should be presented as an integral part of your financial statement for each period for which the financial statements are presented. So we all know that we will be preparing the financial statements. Broadly speaking, annual reports. The annual reports includes all types of information about the company, and the part of the annual reports is the presentation of financial statements, and the financial statements include profit and loss account, balance sheet and a cash flow statement. For a company form of organization, these are the three key statements can be presented in the annual reports and as a part of the financial statements. So they will be prepared for a period of 1 year normally. So the accounting period for any form of organization is 1 year, typically 1 year. So this can also be prepared for a period of 3 months or 6 months or 9 months as desired by the company for the internal requirement. But for the regulatory purposes, any financial statement should be prepared for a period of 1 year. Similarly, the cash flow statement also will be a part of the financial statement presented by the. So let us try to understand the definition of what is meant by a cash and what is meant by cash equivalents, what are the operating activities and what are investing and what are the financing activities. So these are the key definitions that we need to understand with respect to a cash flow statement. So we all know cash. Cash is nothing but the exchange mechanism that will be normally used in any form of economic activity or for any business activity. So while we are talking about a cash, it includes the physical cash that is lying with the business organization and in the form of demand deposits in the banks. It may be a savings account or it may be a current account, whichever the type of the account the company is operating. So through which these all can be considered as a part of the actual physical cash and readily available cash with the business organization. So first and foremost component of a cash flow statement is to understand what are the actual cash balances available with the company and what are the types of and where are various different types of deposits made by the company. This is readily available cash with the company. Then what are cash equivalents? So normally cash equivalents are nothing but, if you are not maintaining a physical cash with us, so we will be making some investments. A cash equivalent is one such that it is related to a short-term investment made by the company. So to utilize the ideal cash lying with the companies may be investing in short-term liquid investments, where the investments can be easily liquidated as and when required by the company. Typically, a cash equivalent may be investment in short-term or highly liquid investments that are readily converted into amounts of cash and that subjected to insignificant amount of risk in the changes in the value. See, sometimes if you are making long-term investments in any type of shares or mutual funds, they are subjected to market risk and hence their value may not be same in the long run. At any particular period of time, they may be showing higher value, or at any particular time of time, they may be showing lesser value. And what kind of things can be considered as a part of cash equivalents? Cash equivalents are typically short term in nature, that is, which are maybe for a period of less than 1 year, and then they should be easily converted into the cash as and when needed. And also the change in the value also should be negligible. Say for example, if you are investing in any short term shares, it is to be assumed if that value of amount that you invested in the share should be the amount that you can realize in its true form at any time without changing its value. So such type of things can be a part of your cash and cash equivalents. So this is what we need to understand. So cash and cash equivalents represent the physical cash that is readily available with the company, or which is available in the form of deposit with the bank or any other short term investments, which can be easily converted or which can be quickly converted into the true value of its investment without much decline in their value. Probably actually at whatever value they were invested, it can be converted into the cash at that value. So they are called as the cash equivalents. Then what are meant by operating activities? So how a cash can be generated, how a cash can be utilized, it is defined in terms of 3 activities. Operating activities. So what are operating activities? Principal revenue producing activities of the entity and other activities that are not investing or financing nature are called as operating activities. So operating activities are nothing but which are needed to run your business organization on day-to-day basis. And in this day-to-day basis, what are your regular revenues and what are your regular expenses? They can be a part of your cash inflows and cash outflows of operating activities. And they cannot be investing or financing activities. So then what are financing and investing activities? So we will discuss about what are financing and investing activities. So let us understand that operating activities are those which are regular in nature and recurring in nature, and which can be of cash inflows or which can be of cash outflows. The basic thing is that they are recurring in nature. They are happening regularly with the business organization. Investing activities. See, once you generated the amount, so we need to use that amount. How we are going to use it? Whether we will use the amount in the form of expenses or we will use in the form of making an investment. So whatever the expenses that we are making it, and if that expenditure value expires immediately, so it can be a part of your operating activity. So normally, so whenever you are making a huge amount and if its value is not been expired in a short span of time, then it can be called as a investing activity. Normally companies need to invest in the long term assets for the for the running of their business activities in the long run. So normally we need to purchase a machinery, or if you are making any investments, long term investments. So all these can be a part of, say for example, let us understand that difference between a manufacturing entity and a service oriented entity. For a manufacturing entity, purchasing of a machinery will be a part of your investing activities, and for a service oriented company, if it is mostly relying on, say for example, if it is a banking company, for that banking company the investment activity may be investing in the long term funds, long term investments like shares, mutual funds. So for them they may be the long term investments. So investing activities are those activities where the companies will be using the money for the creation of long term assets that will be helpful to run the business organization in the long run. So in this also there will be cash inflows and cash outflows. When we are investing in any long term asset, it shows that it is an outflow. When you are generating any amount from the sale of those assets, it shows that cash inflows. So this is about the investing activities. Then what are financing activities? Financing activities that result in the changes on composition of the equity capital and borrowing of the company. Financing activities basically resembles that from where we are generating the finances for the creation of business structure or for the generation of the sales. No, what are the major sources of financing? So the financing sources may be generally long term in nature and it may be short term in nature also. For example, the long term financing activity of a company is about raising the amount from the equity shareholders. So this is one of the long term financing option available to the company form of organizations. Other than this, they can also raise loans from the banks or any other financial institution as a part of their long term funding activities. Similarly, they can also raise the loans for the short term requirements also from the banking companies or for any other individuals also. So they will be a part of your financing activities. So when you are receiving money, it shows that it is a cash inflow. When you are paying back that money, it shows a cash outflow. So these are the basic definitions that we need to understand about while preparing the cash flow statement. So let us have a brief understanding about, let us summarize the benefits of a cash flow statement. A better insight into the financial structure of an entity, including its liquidity and solvency position. So once we are going through this, all the activities, financing, investing and operating activities, and about cash inflows and outflows, we can understand what will be the liquidity position. Liquidity position is nothing but, are you able to meet your short-term requirements or not? So you can understand that perspective from analyzing the cash flows from the cash flow statements. And the solvency is nothing but your long-term liquidity position. So whether you are able to meet your long-term commitments or not. So you can able to justify that by analyzing the cash flow statements. So the enhanced information for the purpose of evaluation changes in the assets and liabilities and the equity of an entity also. So this will also give you about the scope of whether your value of assets is increasing, or your liability is decreasing, or your equity value is changing, your equity value is coming down, you are returning back any investment made by the companies, what are the dividends that you are paying. So all this information can be understood through the cash flow statement. Enhances the comparability of reporting operating performance by different entities. So we can understand the performance. However the cash position is strong, so that shows how fundamentally a company is strong. So the preparation of cash flow statements will give you an opportunity to compare the operating performance of different entities by analyzing their cash inflows and outflows from different types of activities that are mentioned as per accounting standard 3. Serves as an indicator of amount, timing and certainty of future cash flows. So based upon that, you can able to understand, so what will be the future amounts that you can generate from a specific investment activity or from a specific financing activity, and when you have to return the amount, and when you can able to convert the investments into cash, and the time period and the uncertainty in the cash flows that we are going to generate. All this information can be understood through the preparation of a cash flow statement. Cash flows includes both inflows and outflows, and also includes cash equivalents. When we are talking about cash flows, they includes both inflows and outflows, and we are specifically talking about inflows, it amounts to the cash that is coming into the business organization or its equivalent coming into the business organization. That means when you are liquidating any of your short-term investments, it amounts to getting back your amount. Or when you are thinking about any sales, cash sales can also be considered as a part of your cash inflows, and also outflows can be in the form of investing activities, or outflows can be in the form of returning back your finances, or it can be in the form of making any expenditure. So they can also include the cash equivalents. As already we discussed, it includes cash on hand and demand deposits in the bank. And cash equivalents are short-term and highly liquid investment that are readily available to be converted into the cash. So cash and cash equivalents include demand deposits, certain short-term investment, and some in the case of bank overdrafts also will be a part of cash and cash equivalents. How a cash flow statement can be prepared? See, as we already understand, as per the guidelines given in the accounting standard 3, we can understand how to prepare a financial cash flow statement. So cash flow statement can be prepared by classifying all the business activities into 3 categories. That information should be presented in a step-by-step manner in the form of a statement. So before we are going to prepare a cash flow statement, let us try to understand theoretically what components can be a part of that items. As we already discussed, operating activities. So operating activities are nothing but the activities that are typically regular in nature, recurring in nature. So they can be revenue generating, or they can be payment of cash. So first and foremost thing is that what we need to do is we need to identify what are the operating activities. So normally the operating activities, inflows from operating activities includes cash collections from the customers, from the sales of goods and rendering of the services. So as I mentioned, operating activities are typically recurring in nature and are regular in nature. They can be revenue generating also. For any business organization, selling of the goods and then any provision of services is the core revenue generating activity. So under the first and foremost thing that we need to understand is, under the cash flows, what are the core revenues or what are the core cash flows a company is generating in the form of selling of its goods or in the form of provision of services. Then apart from their core business activity, that by selling manufacturing goods or by trading in goods or by providing a provision of services, there may be some other sources of revenue also will be available for the companies, which may not be the core, but they will be also a supportly receiving revenues. So normally they includes royalties, any other fees and commissions the companies are receiving in the form of any other additional services they are providing. So normally it happens with respect to any type of business organizations. It may be a service oriented company or it may be a manufacturing company. Apart from selling of the goods, they can also get royalties and fees for any specific services they are providing. And also, what other types of incomes also we can consider as a part of cash inflows? Cash refunds of income taxes, unless they are specifically identified with respect to financing or investing activities. Sometimes whatever the refunds that we are receiving from the income tax also can be shown as a part of your cash inflows from the operating activities. So they need not be a part of financing or investing activities. The return should not be related to your financing or investment activities, and if they are related to your regular operating activities, such type of returns from the income tax can be a part of your cash flow statement. So these are basically the basic cash inflows from the operating activities of a company. So then what are the cash outflows? What are the cash flows from the operating activities? That is, what are the regular operating activities that where expenses will be paid by the company. So it is related to payment of cash to the supplier of goods and services. So whatever the goods are, whatever the raw materials that we are receiving, or we will be receiving certain type of services from the outside people also, and based upon that we will be generating our goods and our services we will be providing to the other people. So what are the payments that we are making to those suppliers and those services, and cash payments to or behalf of the employees. So whatever the cash payments we are making to the employees. So salaries, this is also a regular operating activity and it is recurring in nature, and also we need to pay to the employees. So it can be a salary or it can be a wages to the labor for a manufacturing entity. Cash payments of income tax, unless they are specifically identified with financing and investment activities. So if you are going to pay income taxes based upon your operating position or based upon the operating profit that you generated in a company, so that can be a part of your cash outflows of the operating activities. So these are the basic outline about the operating activities of a company. So they include cash inflows generating from the sale of goods and rendering of the services, and by the provision of any other ancillary services also will be receiving revenue. And apart from that, cash outflows include the payments to the suppliers of the goods and services, and a payment to the employers, and the payment of income tax. So this is the outline about the operating activities, and we'll try to understand what are investing activities. So investing activities include the purchase and disposal of plant property and equipment and other long-term assets, such as investment property. Investment activities are nothing but whatever we will be receiving money from different sources, that is nothing but financing things. After receiving the money, we will be utilizing it. So if it is related to regular activities, it comes under operating activities. If it is related to long-term perspective, then it covers under investing activities. What are the cash inflows? How we will be getting cash? So when we are making any investments in the plant property equipment or any other debt instruments and any other equity instruments as a part of your long-term investment requirements, they will be termed as cash flows from the cash outflows from the investment activities. It includes purchase of plant property and equipment, acquisition of debt instruments or acquisition of debt instruments of other entities, purchase of equity instruments of other entities, unless held for trading purposes or considered as cash equivalent. Trading purposes means normally some financing institutions will make investments into equities as a part of their trading activities, not as a part of their long-term investment strategy. So they will be covering under the operating activities again. So whatever the revenues that we are generating, whatever the income of cash inflow of cash is there, it will be considered as a part of operating activity. Similarly, if you sold off this property, plant property and equipment or any other debt instruments, whatever the proceedings that we are receiving back from them can be termed as cash outflows. When we are making investment into this, it is called as cash inflows. So this is an overall perspective about cash investment activities or investment activities. And the next one is, and the final one is financing activities. Financing activities include resources and returning of resources to the owners and lenders of the business. So cash inflows, from where we'll get the cash? First source is from issuing of capital, and the other one is debt instruments, and other one is bank borrowings. As we already discussed, that shareholders are the real owners. They will make their own contribution to the business organization. So this is the first source of finance that will be receiving by the company in the form of share capital. And other thing is that the companies can also issue debt instruments, and they can also borrow from the borrowings. So these are the different ways in which the company can generate the large volume of money to create infrastructure for the business or to run the business organization. Normally, running of the business organization is dependent upon the working capital management. But for the long-term investment perspective, the financing, the amount generated in the form of financing activity will be beneficial. And what will be the outflows? Normally, whatever the amounts that we are receiving, we need to pay back them. But whatever the cash we are receiving in the form of financing activity, it is not an immediately paid amount. It takes a time, specific period of time. So whatever the amount we are returning to the shareholders, and whatever the amount we are repaying back to the debt, and whatever the amount we are repaying for the bank borrowings, can be termed as a part of your cash outflows. So this is the basic outline about cash inflows and outflows of a business organization from the financing activities. So everybody should understand that preparation of cash flow statement is mandatory for the company form of organizations, and it is voluntary for the other form of organizations, but preparation is recommendatory in nature. It will give you an overall picture about the cash inflows and outflows of a business organization from revenue. So while preparing the cash flow statement, one need to understand, one need to have an expertise in understanding what are operating activities, what are investing activities, and what are financing activities. So this will give you an idea about classification of cash inflows and outflows from various sources, and how you are going to use it, whether you are going to use it for short term purposes or whether you are going to use it for the long term purposes. So that objective we need to understand. So basically, the primary focus in preparing the cash flow statement should be on the operating activities, because they are regular in nature, and we need to have a very micro level understanding about which are cash generating activities and where we are creating an obligation or due for the future requirements need to be understood with respect to the operating activities. And investing activities are may not be regular in nature. They may be infrequent, and we may not be thinking about it in the short term requirement. We may be thinking about investment activities in the long run only. So they will be having, compared to operating activities, the scope for the investing activities may not be recurring in nature, but they have a significant impact on the business performance and business position. And financing activities are obviously, they are also may not be recurring in nature or regular in nature, but they will serve as a basis for the organization for the creation of infrastructure, or for the creation of infrastructure and for running the business organization. So understanding about both investing and financing activities is also important, but the more focus should be on the operating activities, which will have a greater focus in the preparation of the cash flow statements. Thank you all.